$71 per ounce. That's where silver hit overnight. Not last month, not last year. Overnight. A 40% crash from the highs, wiping out $2.7 trillion in value. That's equal to the entire cryptocurrency market cap evaporating in hours. But here's what nobody's telling you. This isn't the crash, this is the revaluation. And if you don't understand the difference, you're about to lose everything you own. Because what happened next proves we're not in a normal market anymore. Silver bounced 17% in a single session. From $71 to $83 an hour. Gold recovered $250 of its $450 loss. These aren't market movements, these are convulsions. And they follow a pattern that has destroyed every empire in recorded history. 3 times this has happened. 3 empires fell, we are the 4th. Same pattern, same sequence, same outcome. Let me show you something that will change how you see what's happening right now. When an empire collapses, it doesn't happen all at once. There's a sequence, a mathematical certainty that plays out in stages. Stage 1, the empire debases its currency to fund wars and welfare. Stage 2, the physical commodity markets disconnect from the paper markets. Stage 3, the paper markets collapse, and overnight, the real value of hard assets explodes. This isn't theory, this is pattern recognition across 2,000 years of human history. Rome, 3rd century. The denarius was 95% silver under Augustus. By the time of Claudius Gothicus, it was 0.5% silver. The empire debased its currency to pay soldiers and fund endless wars. What happened to silver? The paper value crashed as confidence collapsed. But the physical metal? Hoarded, hidden, fought over. Because people knew. When the ledgers lie, only the metal tells the truth. The Western Roman Empire fell in 476 AD, verified. Dutch Empire, 17th century, the richest nation on earth. They financed wars against England, France, and Spain simultaneously. They issued bonds. They printed currency. They created the world's first true financial markets. And then the debt came due. The Anglo-Dutch Wars drained the treasury. By 1780, the Dutch guilder had lost 30% of its value. The empire that once ruled global trade became a secondary power in a single generation. The physical gold and silver held by Dutch families. That survived. The paper promises? Worthless? Check. British Empire, 20th century. In 1914, the pound sterling was backed by gold and was the global reserve currency. 2 world wars later, Britain was buried in debt. In 1931, Britain abandoned the gold standard. In 1944, Bretton Woods made the US dollar the reserve currency, not the pound. By 1976, Britain had to get bailed out by the International Monetary Fund. The empire that ruled a quarter of the globe was bankrupt in 60 years. But here's the key. Those who held physical gold and silver during the collapse, they didn't just survive, they thrived. Because when paper dies, metal becomes the only language of value. Verified. Now, the United States, $36 trillion in debt. $9.6 trillion of that debt matures in the next 12 months. The most ever. This accounts for 33% of all outstanding debt, one of the highest percentages in history. And it has to be refinanced at significantly higher interest rates. This is double the number we saw before the 2020 crisis. Not might be a problem. Will be a problem. Mathematical certainty. On top of that, the US government just shut down because it cannot get its spending under control. Not because it doesn't want to, because it can't. The system is too big. The obligations are too large. The political will doesn't exist. Meanwhile, $10 trillion was wiped out in global markets in just 3 days. Gold down 20% from its peak, silver down 40%. These are assets that are supposed to be safe havens, and they're moving like meme coins. You can't unsee it once you see the pattern. But here's where it gets truly insane. Central banks did not start selling gold. Tether did not sell its gold. The US government did not find a plan to reduce debt. In fact, nothing in the fundamental backdrop changed since Thursday. So why is gold puking so hard? Why is silver crashing? Because this is not a fundamentals-driven sell-off. This is a forced liquidation event. Someone needs liquidity, and they're selling what they can sell, not what they want to sell. This is the second stage of the empire collapse sequence. The paper market is disconnecting from the physical market. And when that gap becomes too wide, the paper market dies. Here's your proof. While silver crashed to $71 on the COMEX, people in Singapore and Australia were queuing to buy physical gold and silver. Not because prices were low and they wanted a deal, because the metal is running out. In Hong Kong and China, no queues were reported. Why? Because silver is broadly sold out. Dealers pulled their offers. There's nothing left to sell. In Europe, same story. Physical silver gone. Premiums exploding. Reserve in Singapore, one of the world's largest private silver vaults, reported that physical silver demand increased during the crash last week. Let me say that again. As the price cratered, demand went up. Not down. Up. They said the divergence between paper and physical markets is growing, and they expect physical shortages to get worse, not better, worse. Look at China. On JD.com, China's largest e-commerce platform, the price of silver today is $163.35 per ounce. COMEX is at $83. That's a 95% premium. JD.com, $163. COMEX, $83. A 95% premium. And silver is still in backwardation on the futures market. That means near-term contracts are trading higher than long-term contracts. That only happens when there's a shortage of physical metal. You can't cure a physical shortage by smashing the paper price. All you do is widen the gap until the paper market breaks. Shanghai is pricing silver at $109.99 per ounce on the spot market. The Western spot is at $8,247. That's an $18.52 premium, 22% higher than the West. This was 43% over the weekend. It's compressing, but it's still 22%. The Chinese are paying 22% more than us for the same metal. Why? Because they know the paper market is a lie. They know the physical market is the truth, and they're willing to pay the premium to get their hands on real metal before it's gone. This is not opinion. This is data, pattern recognition. The same thing that happened in Rome when the denarius collapsed. The same thing that happened in Amsterdam when the guilder died. The same thing that happened in London when the pound lost reserve status. The paper market disconnects, the physical market explodes, and the people holding paper wake up one morning to find out their wealth was imaginary. Let's talk about what this looks like for you, not in abstract terms, in your actual life. Stage 3 of the collapse sequence is when the realization spreads from the insiders to the general public. When everyone figures out at the same time that the paper is worthless and the metal is real, that's when the panic starts. ATMs stop working because banks don't have the liquidity. Grocery prices double overnight because the currency is collapsing and imports shut down. Gas stations run out of fuel because supply chains seize up. This isn't Mad Max fiction. This is what happened in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. It's happening in Lebanon right now. It's not might happen. It will happen. The only question is whether you're prepared or you're not. Here's the truly disturbing part. The volatility we're seeing in gold and silver right now, that's not the market finding a price. That's the market breaking. When gold sells off, while equity futures are falling, while Bitcoin is falling, while yields are dropping, that's not normal price action. That's stress. That's margin calls. That's forced liquidation. In a true margin call event, funds don't sell what they want to sell. They sell what they can sell. Gold and silver are liquid. They're profitable positions for many institutions, so they become the first piggy bank to get smashed when the margin clerks come calling. CME just hiked margin requirements on silver futures. That means traders have to post more capital to hold their positions. If they can't, they get liquidated. That creates more selling, which creates more margin calls, which creates more liquidation. It's a doom loop. And the only way it stops is when the selling exhausts itself, or when the physical market completely disconnects from the paper market and the paper market becomes irrelevant. We're watching the everything bubble pop in real time. The S&P 500 is trading at the most expensive valuation multiples in history, higher than 1929, higher than 2000. A mean reversion from these levels is not just likely, it's mathematically required. And when that happens, everything gets dragged down initially. Stocks, bonds, commodities, crypto, everything. That's what happened in 2008. That's what happened in March 2020. Metals get sold with everything else because people need cash. But here's the key. When the selling in metals stops, but equities keep falling, the bottom is in. That's when you know the smart money has rotated from paper to metal. Here's the question everyone's asking. Is $71 the bottom? Or is this just a relief rally before more pain? The honest answer is we don't know yet. But here's what we're watching. Bitcoin. It closed the weekend at $76,000. The low was $74,500. If it breaks below $74,000, that confirms significant weakness, and that selling pressure will spread to all risk assets, including silver. If it stabilizes here, that's a sign the panic is exhausting itself. Second, does the bounce from $71 to $83 hold when New York opens? Or does it fail and we retest $71 or go lower? The fact that we bounced 17% in hours is encouraging. Gold up 7% from its lows, silver up 15%. But we need confirmation. If New York opens and the buying continues, the worst may be over. If it opens and the selling resumes, more pain is ahead. Third, do equity markets stabilize or do they gap down hard and drag metals with them? A deflationary crash like 2008 pulls everything down initially. If stocks crater, metals will get hit again in the short term. But that's also when the opportunity is greatest, because the fundamentals haven't changed. Debt is still exploding. Deficits are still out of control. Geopolitical tension is still rising. Monetary uncertainty is still the defining feature of the global economy. All of that is still there. Volatility does not equal trend reversal. Fourth, does the Shanghai premium hold at 22% or does it compress? If it compresses toward 10% or lower, that signals physical is weakening. If it holds or expands back toward 30% to 40%, that signals physical is strong and paper is losing control. The Shanghai premium is the canary in the coal mine. It tells us whether the Chinese, who are the largest buyers of physical metal in the world, still believe in the revaluation thesis. So far, they do. Do we get any news on bank stress, government shutdown resolution, or geopolitical escalation? Any of these could move markets violently in either direction. The system is so fragile right now that a single headline could trigger another wave of panic or a massive relief rally. We're in a news-driven, headline-driven, liquidity-driven market, not a fundamentals-driven market. That means risk is extreme. Let's zoom out and look at the big picture, because this is where the hope lives. Silver is nowhere near a top or bubble. It's severely undervalued versus stocks. The gold-silver price ratio is currently 57 to 1. The historical ratio is 15 to 1. The COMEX vault ratio is 1 to 12. The mining ratio is 1 to 8. The LBMA vault ratio is 1 to 3. Available above ground supply is roughly 1 to 1. Fundamentals will take over the pricing mechanism soon. When that happens, silver explodes higher to catch up to these ratios. Not might, will. Because here's what people need to understand. In Western gold and silver markets, there's more paper metal than real metal, way more. The paper market is a fiction, a ledger, a promise, and when promises break, only the physical survives. The sell-off is paper dumping to fool the masses into avoiding metals when the stock market collapses. Look how unstable gold is, they say. Look how risky silver is. But physical buyers know better. Singapore Qs, Australia Qs, China and Hong Kong sold out with wide premiums. JD.com, 95% premium. This is physical, overwhelming paper in slow motion. Bank of America's bull and bear indicator just registered one of the most bullish readings in history. From a contrarian perspective, extreme bearish sentiment often marks bottoms, not tops. When everyone is terrified, that's when the opportunity is greatest. For those who saw value in silver at $120 last week, the current price of $83 represents a significantly improved risk-reward proposition. That's the opportunity being presented by this volatility. Let's be brutally honest. Leverage trading in these conditions carries exceptional danger. If you're trading on margin, if you're using options, if you're in leveraged ETFs, you can get wiped out in hours. This is not a game. This is not a get-rich-quick scheme. This is a wealth transfer. And in every wealth transfer in history, the people who survive are the ones who hold physical assets, who have no debt, and who can wait out the storm. The people who get destroyed are the ones who are leveraged, who panic, and who sell at the bottom. We're not at the cliff. We have already walked off it. The question is not whether the paper system collapses. The question is whether you're holding paper or metal when it does. Rome debased the denarius. The Dutch printed the guilder. The British abandoned gold. And in every case, the paper died and the metal survived. Same pattern, same sequence, same outcome. The only difference is the speed. And this time, because everything is digital, because everything is leveraged, because everything is interconnected, the speed will be exponential. But where does this leave us? It leaves us staring directly at a market that has split cleanly into two separate realities. On one side is the paper market, futures contracts, ETFs, derivatives, and layers of leverage built on top of promises. This is a market that exists mostly on screens in New York and London, governed by margin requirements, liquidity constraints, and forced selling. On the other side is the physical market, real silver bars and coins, vault inventories, shipping delays, premiums, and people standing in line trying to convert currency into metal. Right now, these two markets are not just diverging, they are completely disconnected. Across the world, the signals are impossible to ignore. In Singapore and Australia, buyers are queuing up as paper prices crash, not to sell, but to buy more. This is not panic behavior, it is accumulation. In China and Hong Kong, retail silver is sold out, even as the global spot price suggests weakness. On JD.com, one of China's largest e-commerce platforms, silver is trading at a 95% premium to spot. That level of premium doesn't exist in a market with excess supply. It exists when paper prices no longer reflect physical reality. At the same time, silver remains in backwardation, meaning near-term delivery is more expensive than future delivery. That is the market sending a very clear signal. Metal available now is worth more than promises for later. And despite all of this pressure, Shanghai vault inventories remain stable. There is no flood of metal entering the market, no evidence of widespread liquidation, and no sign that physical holders are losing confidence. This is not a fundamental collapse in demand. This is not a story of people abandoning silver. What we are witnessing is paper manipulation colliding with forced liquidation. At the same time, physical demand quietly strengthens. Hedge funds and leveraged players are being forced to sell, not because silver is weak, but because liquidity is tightening across the system. When credit tightens, leveraged positions are unwound indiscriminately. Everything gets sold to raise cash, even assets that are fundamentally strong. That is how paper markets behave under stress. Physical markets behave very differently. Physical buyers don't receive margin calls. Physical holders don't get liquidated at the worst possible moment. Physical demand doesn't disappear just because interest rates rise or volatility spikes. Instead, the divergence continues to widen. Paper prices fall while physical premiums rise. Availability shrinks while trading volume explodes. Delivery times extend while futures contracts trade in massive quantities with no intention of settlement. This is not convergence. This is structural fracture. And history is very clear about what happens next. When paper and physical markets remain disconnected for long enough, one of them must break. They cannot coexist indefinitely while telling opposite stories. Every major commodity crisis in history confirms the same outcome. It is the paper market that breaks, not the physical asset. This brings us to the unresolved tension at the center of this move. Silver fell to $71 and then surged nearly 17% to $83 in a violent bounce. That kind of move is not normal. It is not driven by retail traders chasing momentum. It is the release of stress, the covering of short positions, and the snapback of an overextended system. But the question remains unanswered. Does New York confirm this as the bottom, or was this simply a relief rally before another leg lower? That uncertainty exists only in the paper market. In the physical market, the message is already clear. Buyers are lining up, dealers are sold out, premiums are rising, backwardation persists. Physical markets are signaling strength, urgency, and scarcity. They're doing this because they understand something most people still don't. This is not a dip. This is not a normal cycle. This is not a temporary dislocation. This is a revaluation. Revaluations are never smooth. They are violent, disorderly, and fast. They happen when trust collapses, when leverage unwinds, and when paper claims are exposed as excess promises. When this revaluation completes, silver will not be trading at $83. It won't settle at $100 either. It will be $200, $300, or higher, depending entirely on how severe the paper collapse becomes. The price doesn't rise because silver changes. It rises because the system around it fails. This is not a wealth transfer from poor to rich, no matter how often that narrative is repeated. This is a transfer from paper holders to asset holders, from those who trusted promises to those who demanded delivery. It is a transfer from people who believed the system would always function to those who recognized the pattern early, from claims to ownership, from leverage to reality. Once you see the sequence, it becomes impossible to unsee. Suppression leads to leverage. Leverage leads to stress. Stress leads to forced liquidation. Forced liquidation leads to divergence. Divergence leads to failure. If you're still watching, if you are still here, that means you already understand this. You see that price is lying, but behavior is not. Subscribe if you want more of this, because what comes next will not be subtle. It will not be slow, and it will not be comfortable for anyone still trapped in paper. The bottom might already be in, or there may be one final shakeout designed to scare people out. But the direction is no longer ambiguous. The paper dies, the metal survives, same pattern, same sequence, same outcome.